Warm welcome guys to another week ahead video. This week's video will cover the trading week running from Monday the 21st to Friday the 25th of June 2021. Our main attention this week will turn to the British pound, where we do of course have the Bank of England coming up with their scheduled policy meeting on Thursday. Now, the overall bullish fundamental outlook for sterling remains firmly intact in our view. The UK's overall economic recovery has been much faster, much stronger than previously expected by both the market as well as the BOE. Largely, of course, thanks to that massive successful vaccination rollout that we've seen in the UK. We also have seen GDP data continuously surprising to the upside, with the Bank of England at their prior meeting actually forecasting growth to now rebound back to pre-COVID levels by the end of the year. We've also seen things like the activity data in the form of the PMIs also coming in solid, with the composite PMI. Now remember, that includes both your services as well as your manufacturing sector, jumping to a new record high of 62 in May. And according to the IHS market research, we are well above the levels that would normally see policymakers making the case for some potential tapering in the Bank of England. Now there is of course, nothing normal about the nature of the current post-pandemic recovery that we've seen in the global economy, but still the data has really been stellar when it comes to the growth and activity data. Now, like we said, these aren't normal times, so one must keep the context of this unique current post-pandemic economic recovery in mind. But again, the numbers have been really stellar. In terms of the labor market, the data has also been positive. We saw quite a big reduction in jobless claims with the prior print, and we also saw the Bank of England significantly lower their forecasts for the unemployment rate at the May meeting. And that was very important because remember, a big caveat for the labor market right now to keep in mind is that the UK, the government through that furlough scheme, has synthetically propped up the jobs numbers for the last couple of months while the economy has been stuck in the restrictions. So we don't really have a clear glimpse of the true state of the labor market, and we'll only see that once the government's furlough scheme runs out from September. But the good news is, once again, that we've seen those forecasts for the unemployment rate coming down significantly, despite furlough schemes still needing to be phased out. So that was another positive in terms of the labor market as well. Now, we did have retail sales coming out very disappointing on Friday, coming in well below the market's minimum expectations. Now, the miss was big, but so too was the base comparison that we were working with of something like April. Remember, April saw a huge surge, over 9% in retail sales, as consumers tried to rush out and spend after being locked down for so long. And apart from the very steep base comparison to the prior month, the other important point was that the type of spending has shifted away from your delayed spending. Now that means things like vehicles, furniture, clothing, etc., and have shifted more towards your services spending, your social spending, according to ING Investment Bank. And that'll be things like restaurants and bars, hotels, etc. So the miss was bigger than expected, but the impact is less likely to be a game changer for the bigger picture right now, because retail sales, apart from that miss, is still well over 9% above the pre-pandemic levels. So, yes, it was a big surprise to the downside, but it wasn't as big or as bad as those numbers suggested. Now, the other big surprise that markets took note of course, was the big jump that we had in the inflation numbers. Inflation data for May came in much higher than the market's maximum expectations for both the headline month-over-month and year-over-year prints, as well as the core measures, with the month-over-month posting the fastest rise that we've seen in decades. Now, this was very similar, of course, to the surprises that we've seen on the US side as well. Obviously, just not to the same type of extent as we've seen those US numbers surprising to the upside, but still solid numbers coming in for CPI. The beat in the CPI data saw markets increasing their policy normalization expectations for the Bank of England, and it has helped to basically just solidify the market's ongoing anticipation that the Bank of England would be the next major central bank to tilt slightly more hawkish, in line of course with those like the Bank of Canada as well as the Reserve Bank of New Zealand. Now, it's also important to take away is that even though the print was higher than expected, and even though it did come in above the Bank of England's 2% target, the Bank of England shares the Fed's view right now that the current inflationary pressures that we're seeing is going to be mainly or mostly transitory in nature, and it is expected to ease back in the months ahead. So even though the higher CPI print was of course important, the Bank of England is likely to signal an ongoing patient stance on price pressures, of course depending on how far they continue to deviate. Having said that though, seeing the Bank of England doesn't really have average inflation targeting framework like the Fed does, their reaction function is expected to be more sensitive, of course, to similar type of jumps going forward. So with all of this in mind, how is the Bank of England likely going to react to all of these positive data points that we've seen recently? Now, when it comes to Thursday's meeting, arguably the bank is going to try and be as quiet and as uneventful as possible. The May meeting saw a lot of excitement because we had that reduction of the quantitative easing program, that tapering down to 3.4 billion per week, but they of course kept the size of the program running at 875. The reason for the adjustment was mainly framed as being technical, saying that, hey, we want to scale it back so that we can run this thing out until the end of the year. Now, the bank also did some hefty revisions to their economic forecasts, and they did sound overall more optimistic regarding the economic outlook. So because the June meeting, this one for next week, will have no monetary policy report, market participants are expecting the bank to just keep things very, very uninteresting, not really trying to deviate too much from that May message. Now, the other interesting point to keep in mind, though, is that even though the bank arguably, like we've seen, has lots of reasons to still sound optimistic at this meeting, they might want to play for time until the August meeting to take any further steps toward tighter policy and also not sound too positive, because there's reasons right now for them to take a slightly more patient stance. And one of them is, of course, the virus numbers, where the most recent data has been a little bit discouraging for the UK. Now, the UK has been a great example to the rest of the world regarding that successful vaccination campaign. But despite the successful campaign, that Delta variant has been a real concerning one for the government. We've seen that new upward trend in new cases, and this is largely attributed to that Delta variant. And that has basically caused the government to put a 4-week delay to that planned reopening that was set to start from the 21st of June. Now, apart from that, we've seen that EU-UK relationship also taking another hit due to that Northern Ireland protocol that continued issues. And that has seen some heated and punchy rhetoric between the two sides, with some EU officials actually threatening sanctions, etc. So there is negatives in the mix right now that we do need to keep in mind. The virus being one, that political situation being another. And that could, cause the Bank of England to just be a little bit more patient in terms of not trying to lay on that optimistic tone too thick. What's also very interesting and clear is that the rates market is not at all bothered by these short-term risks like the delayed reopening, like the current political tensions, because if we take a look at the SONIA quarterly futures, you can see markets aggressively implying higher rates for the Bank of England, with over 10 basis points of tightening implied by SONIA futures by this time next year, and then a total of 30 basis points of tightening implied by December of next year. So the risks running into the meeting is that there's a lot of hawkish expectations already built into the rates part of the market, and that could spark a little bit of an unwind of this if the bank doesn't come across as hawkish as market participants might have hoped after that CPI print. Now, in this past week, we've obviously seen a hefty unwind in pound longs against the US dollar, especially after that FOMC meeting. So there is a hefty divergence right now between the way that the pound has been pre-positioned going into that BOE meeting and the way that SONIA futures or the rates markets are currently implying going into the meeting. So that does make a little bit of a mixed bag going into it from a pre-positioning point of view. However, it is worth noting that we've had numerous market participants like Nordea, ING, Vanda, all of them think that being tactically short the pound going into this week's BOE meeting actually looks attractive from a risk to reward point of view. Some of them argue that firstly, that reopening story we've had in the UK is arguably right now already mostly priced in. Secondly, positioning has been looking stretched for something like the pound as well as the euro and the CAD, of course. And we've obviously seen that huge jolt to the upside in the US dollar. And the third reason given by them is that, of course, the things that we've been focused on, as well as like the virus cases, as well as that delayed reopening and that resurfaced political concerns between the EU and the UK. So these are important things to keep in mind. From a rates market point of view, it does look like the markets might have gotten a little bit ahead of themselves in what they're pricing in for the Bank of England. Of course, the bank can come out overly hawkish. It is still possible, but again, given those short-term risks, given the fact that we've got no monetary policy report coming up, if the bank comes out and just keeps everything on a very even keel and doesn't really try to shake the boat or rattle the boat too much, it might disappoint the rates market, and that could see a little bit of an unwind in some of these more hawkish expectations going into the meeting. So that's a real risk that we do need to keep in mind. Now, in terms of a trading plan, it's going to be real simple. We're going to break this down between bullish and bearish potential outcomes. Taking a look at the bullish ones, if we do see the bank taking a more optimistic outlook given the recent data points, that is of course expected to be more positive for the pound and positive for gilt 10-year yields. We do have participants like Deutsche Bank that is expecting the bank to come out with a even more optimistic overall tone regarding these more positive data points. On the bearish front, of course, if we see no change in the tone despite these better economic data points, that's expected to be more negative on the currency as well as yields. Back to the bullish side, if we do see a surprise second dissenter in that QE vote, that is also expected to be more positive. Now remember, the prior dissenter was of course Andy Haldane. Now he's a known outlier, known hawk in the Bank of England, and if we do see someone else potentially moving forward with also dissenting in that QE vote, that is expected to be more positive as well. Again, on the bearish side, if we see voting distribution remaining unchanged, of course, that's also expected to be more, not really more of a negative, that's arguably going to be more of a neutral outcome because the markets are really expecting that from this meeting already. Now, in terms of bullish outcomes, again, if we see the bank alluding and in their language and the rhetoric signals to the markets that further tapering is on the cards for that August meeting, that is obviously expected to be positive for sterling and positive for gilt yields as well. Remember that right now the markets aren't expecting much from them, they're just expecting a more positive tone, but if they do sneak in some rhetoric and language there that alludes to the markets that, hey, more tapering is coming, that is of course expected to be more positive for the meeting as well. In terms of the bearish side to that, again, if they stay silent on any tapering and potentially even push back slightly against some of those overly optimistic expectations we've had, that is obviously expected to be more negative as well. And then in terms of the fourth one, inflation, if the bank says that they're really worried about this recent rise in inflation, remember the reaction function is slightly different compared to the Federal Reserve. Even though they do think inflation is mostly transitory, the reaction function is different because they don't have average inflation targeting like the Fed does. So if they do come out and saying that, hey guys, we're really worried about inflation right now, that is expected to be more positive because that is the markets will interpret that as the bank saying that, hey, we're uncomfortable about inflation, expect sooner or higher rates a little bit sooner than prior. So that is an important one to watch. And then again, on the bearish side, if they come out stressing that, hey, this inflationary spike is mostly transitory, we're not worried at all, that is of course expected to be more again, more neutral than negative because the markets are expecting the bank to come out and stress that about inflation. Now, remember, guys, the potential outcomes outlined in these examples are just potential market reactions that we would expect the market to take in line with some of these outcomes. The markets can always, of course, surprise in the way that it reacts. So this info is never intended as trade calls per se, but rather intended as a framework to use in your own scenario planning. So guys, hope the video has been helpful. As always, any other questions, please don't hesitate to let us know.